Well, hello, traders and investors. My name is Roger Scott. I'm the head trader of WealthPress. Today is Friday. It's the last trading day of January. I can't believe that. Wow. I can't believe January is already over. Where has 2021 gone? I'm still thinking 2020 February. Folks, let me show you the market. This is pre-open. It looks very similar to how it looked for the last few days. It's opening lower. Prices are going all over the place. Markets are being manipulated by these small cap stocks. It is a mess. So we've got the personal income and outlay report. And last month, the expectations were that personal income was going to edge higher and it went lower. I'm hoping the consensus is zero point 0.1 positive. If we can go above 0.1, it would be really good. Now, the news should have just come out, so let's see what it is. Let's see if we can get a good real-time gauge on it. And if not, we'll just keep updating. I guess not yet. The consensus is still there in the range. Let's start with the global economy, and then we'll check back in a few minutes. But again, just wanted to show you the markets are not looking well right now. The Dow Industrial remains at the 50-day moving average, and it looks like it's going to go down further. The S&P 500 and the NASDAQ, let me put the moving average on here so you guys have some idea of what we're talking about here. Look at that. We're real close to the 50-day moving average there. We're getting closer to the 50-day moving average on the NASDAQ 100. But as far as the Dow Jones Industrial, we are already there. And folks, I'm going to tell you right now, if we break this level, we're going to go lower into the twilight zone. Now, let's check again. I want to get this report as it comes out so I could talk a little bit about it. And I specifically waited to do this video for a little later. Oh, look at that. 0.1. All right, 0.6. So it is edging a little bit higher. It's not negative. It's going higher, which is positive. It's above 0.1. It's at actually 0.6, which is better. So it is moving in the right direction, although I don't think that's going to have a big impact on the market because it's still substantially below what the target is right now. So things are not looking as good, but at least the personal income numbers are not negative. So now let's jump into global economy. Folks, worries about rising COVID cases is what's getting Wall Street excited, and volatility is running amok. Also, earnings. This is the first week of the major news where we have a flow of earnings. Apple, Facebook, you name it, it's been reporting. Tesla and so forth and so forth. The numbers are mixed. They're not great. They're not terrible. They're slightly better than expected. By the end of next week, we're going to get a really good idea of where we stand. And if you're in my VIP program, my bootcamp VIP program, I'll talk about where we stand later today with earnings. U.S. markets were roiled by a spate of trading small investors of GameStop and other stocks, smaller stocks. They're squeezing the shorts like there's no tomorrow, and they're hurting hedge funds like there's no tomorrow. Big hedge funds. Elsewhere, virus infection spike in Europe and Asia. This is bad, folks. This is how we got to where we are now. Remember last February, December, January, it started in China, Europe, and then by late February, early March, it's made its way into U.S. Renewed travel curbs, negotiations in Washington over President Biden's proposed $1.9 trillion economic package is what's going on right now. Several trading firms put people on liquidation mode only, restricted trading on Webull and others, just on these short squeeze stocks that have been going up like there's no tomorrow. And this is really negative right here. I don't know if you're paying attention. After trading closed, Hong Kong government announced preliminary estimates showing the territory's economy contracted by 6.1%. That's bad. It said output fell 3% in final quarter compared with a year earlier. That's bad. Why? China's the second biggest economy. And Thursday, the government data also showed 847,000 people applied for unemployment. Now, that's better than the 900,000 that we saw the week before, and that's better than the 965,000 that we saw the week before that. But boy, oh boy, I'm telling you, 200,000 is bad. Going from the lowest unemployment levels in 40 years to the highest levels of in 60 years is bad. And the biggest downside is these numbers are not really delayed. They're only delayed by about 5 days. And it's telling us that the number of people applying for unemployment is not declining, which means people are not in the workforce because they're applying for unemployment benefits. And when you take this into account with bad data from Asia, it's not pretty, which we are tethering right now on. We're literally tethering. And if we don't get more aid or if we don't get these stimulus checks, this Dow Jones is going to break. I'm not kidding. It's going to break this moving average. And if we break this moving average, we're going to go down quite a bit. Now, volatility rises when markets get fear. When fear rises in the marketplace, it exhibits a spike in volatility. This is the biggest spike in volatility since we've had in November, and this is the biggest spike in volatility we had in history. Now, I don't think if the market crashes or breaks, I don't think we're going to have a crash, but if the market breaks lower, I think volatility is going to spike to about 50. But I don't think it's going to go higher because we've been here before. We were in panic mode in March of last year. And I mean, toilet papers were sold out, and we went to 80. And I don't think we're going to go there again, but there's a good chance we're going to go to 50 if the Dow breaks. And let me be honest with you folks, a good little downturn for the market wouldn't be the worst thing in the world right now. Why? Let me show you. And again, I've showed you this several times, but I want you to understand this. Because look at the NASDAQ 100, look at the number of stocks trading above the 200-day moving average. Let me show you this. Look at this. Look at this. 89 stocks, highest level in 11 years. And here's the bigger problem. Till a few days ago, the stocks trading above the 50-day moving average, the number went from like 80 percentile to like 70% or 88% to 70%. But the index was still going up, and that's narrowing momentum. And I warned everyone right before this little down turn started that we may be going a bit down. So again, I'm not happy. Let's look at the market. Now, the market hasn't really impacted. The employment numbers haven't really impacted too much. Why? Because if you look at earlier this week, we had GDP, we had FOMC, we have jobless claims. So this is just kind of confirming what we already know. But the markets are vulnerable right now. The number of stocks trading above the 200-day moving average in the NASDAQ is 88%, 11-year high. We are not looking pretty. With that said, last week sometimes I gave you 3 stocks that I believed would trade lower. And now I'm going to give you 3 more. These are 3 stocks that I really liked earlier in the year, but they're breaking down now. First one is Dollar General. Dollar General was a darling. I loved the stock when we were going higher in the summer, but it's breaking down. It looks like the world is turning away from the stay-at-home or the saving stocks or stores that people go to when COVID or when they need necessities like Dollar General. It looks like we're looking more further out into the real world post-pandemic, which may be a mistake based on the data we're getting from scientists that's saying that this new strain, the South African strain, may not be as may not work against the vaccine. May not work. The vaccines may not work against this new strain, or it may not work as well against the new strain. But that's all we know. We don't know all the info. But here is Dollar General. It's been making lower highs, as you can see here, which is one big indication that the stock has topped out short term. Also, the stock is trading at a multi-month low, excuse me. It's breaking down the lowest level since September. That's meaningful. Next, so I would be selling it right around the 200 level, and I would think there's a good profit target at the 190 level. So there's about 9 points here. Next stock, McDonald's. Same thing. McDonald's, if you look further, it peaked out all the way around October. It's been trending down. It hasn't been able to rally already for 2 quarters, and the price is breaking down multi-month. We're trading at the lowest level we've seen since the summer. And again, people were bullish on McDonald's, but again, after September, the stay-at-home environment started dissipating. We started moving back into what will happen outside of COVID or after COVID. The stock is breaking down, and I believe there's a good upside all the way to the 195 level. And again, notice the highs are getting lower. that's a sign that the stock has fizzled out. Last one, CGen. Again, notice the highs are getting lower, and notice the stock is breaking down, and notice there's a nice big fat gap here. I like these gaps. They get filled. I like the stock at the current level, and I think we'll have a nice little downside to the 150 level. So again, Dollar General, DG, MCD, and SGen all breaking down. Now, before I let you off for the weekend, I've got something important for you. The little guys are leading a charge against Wall Street. I mean, have you guys seen GameStop, AMC Theaters, a few other stocks? It's a mess out there. And this can open up opportunities to strike it rich, even if you aren't an expert. For the first time in trading history, the balance of power has swung in another direction. It's as clear as day. Retail investors could have just as much potential to move the markets as Wall Street veterans. If you guys had doubts about this, take a look at GME stock, take a look at AMC stock, and you'll see exactly what I'm talking about. It's a mess. We call this the Robinhood effect, and this Robinhood effect could forge a new path for everyday traders. And I want you to get in on a slice of the pie too. Of course I do. That's why I'm revealing exactly how you could make the most of this opportunity and more. But what I want you to do is to go ahead and check out and get ready for the next Robinhood Capital Flood. It's coming, and I want you guys prepared for it. Click on the link below. Check it out now. Do not miss these opportunities. Main Street and Wall Street, they're on equal footing right now, and I want you guys to get in on it ASAP. Do not miss out, and have a great weekend. And post some feedback for me. I got to have some feedback. I'll answer your questions, and I don't bite. Have a great weekend, guys. Bye.